Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, June 27th, and then we'll see how things look for Wednesday, June 28th. We saw a pretty solid up day. Unfortunately, growth didn't do all that well, so we're still seeing some weakness develop in our charts, but overall, we are showing some improvement. Now we have to see, can the market follow through? Are we getting into that period of June, which historically has been stronger going into the latter part of the month? Now, anything can always happen. At least for right now, support has held. We've been able to go up off of that support and show some technical improvement in our charts. Before I get started, please note that on Thursday, when I try to do Thursday's video, I have an unavoidable appointment during that time, which is right about in the middle of when I prepare everything for the video. Now, I'll try to get something posted as soon as possible, but if I really get dragged down with this, it's going to be probably after the market opens before I'm going to be able to post the video. Also, you've probably been hearing in the news a lot about what's going on in Russia, and there was an attempted coup over the weekend. At least that's what they're saying right now. We don't really know what's going on in that situation. Well, the other country in play right now is the country where I currently reside. So if suddenly you don't see a video from me, it might mean, number one, that we got vaporized in this part of the world, or number two, that I'm on the run and I'll get back to posting just as soon as possible. Now, my hope is that everything calms down, that this just becomes part of a news cycle that quickly fades away and we go on to something else. We don't know what information that we're being told is actually true. That's coming out of the eastern part of Europe. And then we're not always told the truth when it comes to western parts of the media either. So you kind of have to piece all of this together yourself. All right, on another note, I do have a PDF that's in the description below the video if you want to follow along. I also have a private Facebook group that you're welcome to join. I do have a poll that's posted. It's on the YouTube community tab. Please feel free to check that out if you would like to participate. Also, I'm really keeping an eye on YouTube comments. I love the comments. I just don't like the garbage comments, and I try to get rid of those as soon as possible. And I also post on Rumble in case you can't find me on YouTube. Let's go back and talk about what happened. We did have a higher open. We went above the daily pivot at 43.40. Prices climbed above R1 at 43.51. As the day went on, prices kept climbing. We got above R2 at 43.74. And then price seemed to hit resistance at last Wednesday's high, which was at 43.84, before closing slightly off of the high. We never got up to R3. The only thing that I could see on the chart was looking into last week. We were up 1.15% on below average volume. That's a little bit of a concern. Is this just a dead cat bounce before we get set to go even lower? Or are we starting to bounce after pulling back in a more positive environment? That's kind of where we're at right now. The technicals, they're positive. In some parts, they're still showing a little bit more weakness. In other parts, they're showing a little bit of improvement because of this inflation and interest rate scenario. Now, it kind of switched a little bit on Tuesday, where we had some economic reports that were strong, where we had been seeing good news as bad news. Now we're starting to see good news as being good news as far as the economy is concerned. We do want to keep an eye on the whole situation in Russia because of any influence that might have on the stock market if things really start to escalate. What are some comments that we can make? Good economic news was good news. Now, we tend to go back and forth with this over time, where sometimes good news is bad news. Right now, good news is good news. Mega caps did underperform early in the day, but the broad market was showing some improvement. But then later in the day, we saw some strength from the mega caps that really helped the indexes to go higher. Growth did underperform value. That's a little bit of a concern. But if we are really starting to turn and go back up, we should see some improvement in that area. On an intermediate term basis, we're still having our oscillators that are giving us extreme readings. Those are lines that I put on the chart. There's nothing magical about that. So we could still go higher with our oscillators. However, we're starting to roll over. When we get to that chart, I'll show you. The dollar was down and interest rates were up, and we still have all of the yield curves that remain inverted. Sentiment with the update did go back into extreme positive territory at 76, where we had been at 71. Our trend is positive, and we are advancing because the green line has now turned back up, but the ADX itself has dropped below the moving average, but we're still above 20, so we're kind of in that mixture right now. The bias is positive with the update, and I've kept our momentum at mixed to actually negative. We need to see more follow-through than just a one-day bounce. The economic reports that came out, this was mostly taken as good news. The total durable goods orders came in up 1.7% on a month-over-month basis. They had expected it to be down 1%. Last time it was up 1.2%. When you take out transportation, we were up 0.6% month-over-month. They expected it to be unchanged. Last time it was up 0.6%. The FHFA Housing Price Index came in up 0.7%. Last time it was up 0.5%. The S&P Case-Shiller Home Price Index was down 1.7%, but less than the down 2.5% that they had expected, but more than being down 1.1% that we saw last time. Consumer confidence came in at 109.7, better than the 103.8 they had expected. Last time it came in at 102.5. In the same period a year ago, the index was at 98.4, so we are seeing a bit of an improvement there. New home sales were up 12.2% month over month. When you seasonally adjust this, that's 763,000 units, much more than the 665,000 units that they had expected. Last time it came in at 680,000. On a year-over-year basis, we're now going up 20%. Looking at some Isabel Net blog charts, here's the technical overbought oversold composite. Now this chart's a couple of days old, so we have to be a little bit leery of this. We're up above the 80 level. Usually when we get to 75 to 80 or so, that means that we're extreme positive or in overbought territory. Now you can also look at this a different way by seeing that the longer we stay up in this high area, the better the momentum is. Then looking at the S&P 500, against the next 12 months earnings per share divided by Moody's Baa rating plus the dividend yield. Now, that sounds like an algebra problem. What we're looking at here is the blue line is the S&P 500. The yellow line is the S&P 500 with all that gobbledygook thrown in, and it's coming up just a little bit. So it's saying that the U.S. market-based cost of capital implies fair value for the S&P 500 is 3126. We're up close to 4,400 now. So if we were to try to get back in line with that, we would have to see more of a decline. However, you can see that there are times when this yellow line does really underperform the S&P and it can still continue to go up. There are also other times when this yellow line does better than the S&P and yet the S&P declines. So I'm not quite sure how much to really put into this chart. Then this sentiment indicator, which I usually don't look at, because it's usually giving us a neutral sign, it's starting to turn down just a little bit, which is red, which means it's more negative. Then stocks have gained in July, 9 out of the past 10 years. So we're coming up to July now. I'll be redoing the Stock Traders Almanac statistics to get us what kind of an idea that we can look for in July. We're starting to see people use more margin now as the market has been showing some improvement. Then looking at the longest streak of inflows going back to October 21, I don't understand this. That wasn't that long ago. They're trying to make a headline out of something that's not really all that popular. It's like saying, our baseball team has won the most number of games since yesterday. Okay, it's like, yeah, we won today, we lost yesterday. But anyway, looking at the chart, we are seeing flows starting to come down, actually, both with the 4-week line and with the blue area here. So with this chart, it's like their headline says one thing, but they're showing an actual decrease in the other. Then the diffusion index of every possible yield curve inversion, we're going back up now, suggesting that there's a high likelihood based on the yield curve inversion that we might go into a recession. Now, please also note, and I'll point this out in the economic video that I'm going to post in the near future, the person who uncovered this, that did all the research that shows that when we have an inverted yield curve, we tend to go into a recession. Way back in the beginning of the year, in January, he came out and said, this time we might be wrong about that. So that's kind of an interesting takeaway. Then looking at the forward 12 months earning per share, we are seeing a little bit of an improvement here. There are still optimistic forecasts looking forward as far as earnings are concerned. Then the different economic reports, and I'm trying to bring up more charts. Here's the durable goods where we had been coming down and we're starting to bounce back up. Then when you take out aircraft and defense orders, it's also showing some improvement. Then here's the month over month where we have been seeing a little increase in the durable goods orders. Then looking at the FHFA Housing Price Index, after dipping for a lot of 2022, it's starting to go back up. The S&P Case-Shiller Home Price Index, after dipping in 2022, is also seeing a recovery. Consumer confidence. First, we look at the expectations. That's the yellow line, and it's showing some improvement. And then we look at the present reading of consumer confidence, and then the split between the two is where we're at right now. Later in the week, we will be getting the final reading of consumer sentiment. A lot of people tend to put more weight in that report than in this report. New home sales also showing a nice little increase, and I actually have a chart to show you. The reason why I have a chart here is just to see what is the correlation between new single-family homes being sold and the S&P 500. Over the last number of years, they've had a high correlation, but lately we're seeing that really trailing off. Then the median new home price, the 3-month average, has really been declining. That's been helping home sales, but if you're selling a house, that's been hurting you because you have to keep lowering your price. Getting into our analysis and commentary, here's the intraday chart. We did have a little bit of a higher gap open, not a big gap, but we were positive above the daily pivot. We chopped around a little bit, and then we started to show some improvement. We got up to R1, then we just kept going all the way up to R2, blew through that. R3 would have been way up here somewhere, so we never got to that level. And as close as I could tell, this was the high last Wednesday, and we just about got to that level before we closed a little bit off of the high. Intraday chart, where we saw a little bit of strength in the initial overnight session, then some weakness after Europe opened, but then when the US opened, we just took off and went up really well. In the initial overnight session, we are seeing a little bit of weakness in the futures. Large cap growth versus value, where value is still outperforming growth. On a closing basis, both of them were up, but growth was up just a little bit less. Also for the mid caps, growth was up less as well as the small caps, but we were still positive overall. Looking at the growth to value ratio for the S&P, we are seeing a little bit of improvement here, but it never got back up to the unchanged line. If we really hope that the market will go up, we want to see this line really shoot up and start to outperform, and it just hasn't done that yet. Looking at sentiment, we're seeing a little bit of a tick up with the Ulcer Index, but with the update, we saw a decline with the VIX with the line chart as well as the bar chart. The VIX of the VIX is starting to settle down a little bit with its volatility. And the VIX to move ratio is also still below a declining moving average. The equity put call ratio also declined with the up day. The longer term equity put call ratio is still looking positive. Now again, you have to think of this counterintuitively. When we were going up with this ratio, that means the market was under a lot of pressure. When this starts to go down, that's typically when the market is going up. Looking at our other fear gauge, we continue to decline overall, and this fear gauge also ticked down slightly, and we've been declining overall. Folks are back to favoring more of a risk-on posture after seeing a couple days of decline in this ratio. Our advanced decline line, we did see some improvement based on price and volume, and this is encouraging. With the update, we saw a real breakout in new highs, so that's turning our 5-period moving average back up, and our 10-period differential is also starting to turn up. The advanced decline ratio looking more positive. Both the blue line and the red line are above 0 and advancing. The accumulation distribution, we had dropped below the moving average. Well, after Tuesday, we crossed back above it. The NYSE cumulative advanced decline line also showing some improvement. The regular advanced decline line also ticked up. The other advanced decline line for the NYSE that we use were back above this trend line again, so that's more positive. Common stock, based on price and volume, seeing a little bit of improvement. Looking at our broad range of the advanced decline lines, we're seeing some improvement with the NYSE, the S&P, the mid caps, and we're still under the moving average with the small caps, but we are bouncing back up. Here's the ADX, where it's getting a little confusing. The ADX is dropping below the moving average, so that would suggest that the trend is weakening. The green line is still on top, but it's now starting to turn back up. If we have another 1 or 2 up days, it could turn the ADX back higher above its moving average, or we'll have to watch this to see if we're having a weakening trend. Doesn't mean that we can't go long if you decide to do that, but we want to really keep an eye on the green line to see what direction is that going. Shorter term, we are also dropping below the moving average after getting an extreme positive reading, but the green line did tick back up. Volume did decrease on an up day, a little bit of a warning sign. Our short-term analysis, after coming down almost to the August 2022 highs, we're now potentially bouncing up off of that, but you can see down below where we have dropped below average with volume. Looking at our double and triple exponential moving averages, we're coming right back up to both of them. They may provide some overhead resistance. We did almost come down to the 20-period simple and exponential moving average, but now we are potentially bouncing up off of that. If we start to fall, we'll still be looking at this as potential support. After falling below the 10-period moving average in the rainbow and almost getting down to the 20, we're now bouncing back above the 10-period moving average. We're seeing some improvement with the 20, 50, and 200-day moving average study. The Stochk RSI, after getting extreme negative already, we're no longer giving that reading. The force index, which had dropped below 0, has now crossed back above 0. And our short-term stochastics is showing some improvement. We're still declining and trying to turn up in the intermediate term, where we continue to decline after being extreme positive with the longer-term stochastic. Intermediate term, we're still above the dashed line with the balance of power and turned up slightly. Looking at the double and triple exponential moving averages for the 50, the triple did not provide support. We came down to the blue, which is the double exponential moving average. Can we find some support off of that? So far, yes, we did. But now, can we break through the triple period exponential moving average? The go-no-go system is still more neutral to positive with the lighter colored blue bars. Then looking at our highest highs and the lowest lows, we came almost down to this midpoint and we're showing some improvement, but we're not really extreme positive or negative currently. TTM squeeze, though, still continues to decline after giving an extreme positive reading. And here's a longer look at that same chart. We're not really extreme right now with our standard deviations chart. We almost came down to the midpoint. We're bouncing back up, and right now we're in the second standard deviation. Looking at our moving average tree, also coming close down to the 20-period moving averages and so far bouncing back up. If we start to fall, we'll be looking for this to possibly provide some support. McClellan oscillator, this is positive. We were able to cross back above 0 based on the S&P, and the NYSE McClellan oscillator also is above 0. So the summation index based on price is starting to turn back up, but we're not seeing it turn up yet based on volume. So we're seeing a real contradiction here. Now, one thing to keep in mind, the top part of this chart and the bottom part of this chart are calculated completely different. So sometimes that can be beneficial, but sometimes it can make it a little confusing as well. The NYSE summation index based on price actually ticked down as well as with volume. So that's a little more negative. The Erin indicator did not change. We're seeing a decrease in buyers as well as a decrease in sellers. The PPO studies still remain positive in the long intermediate term. We're still above 0 in the short term, but we're starting to flatten out. The Swenlin trading oscillator based on price and volume did show some improvement, but continued to be below 0. The PMO is still starting to roll over. We're also starting to roll over based on price, and we've already rolled over based on volume. Our PMO study with the PMOs that are rising is showing some improvement. We ticked up just slightly with the buy signals, and we're pretty much flat with the PMOs that are above 0. The Elder Impulse system for the S&P has now switched from negative back to neutral. However, the parabolic SAR still remains negative with the dots on top. The slope is now continuing to decline, and the MACD is also crossed over and is negative. So when we look at all of our oscillators, our short and intermediate term oscillators are pretty much negative now. We're still rolling over with the longer term oscillators after giving us an extreme positive reading. We need to see more follow through to the upside for these to have a chance to turn back up. The BPI is still hanging in there. It wasn't up on the up day like maybe you had hoped, but we declined a little bit, but it's still hanging on to this, and it's still above 50. The NYSE bullish percent index was pretty much flat, but also remains above 50. The Chaikin money flow did decline a little bit, but remains positive. The Chaikin oscillator, after going down and dropping below zero, is ticking up, but it's still below zero. The money flow is still above 50 and now advancing. The ultimate oscillator has now dropped below 50 and was pretty much flat. The vortex was pretty much flat with the green line, and we saw a little bit of a decline with the red line. The RSI turning back up with the 14 period, we're above 50. With the 9 period, we are starting to show some improvement. On balance volume ticked up just slightly, and we're still above the moving average. Looking at our 200 period simple moving average study, we did see some improvement when we look inside the S&P. We also saw some improvement with the 50 period moving average study. And here's another look at that same chart just to see. Some people like this kind of chart better. The Pring bottom fisher continues to generate a buy signal. Our line studies, not really anything was decided in here right now based on our quadrant study. We almost came down to the 100% retracement level, and now we are potentially bouncing up off of that. Longer term, we almost came down to the 61.8% retracement level and potentially are bouncing up off of that. Longer term, we still have a ways to go before we get to a support level. The 20 period simple moving average of the open, high, low, and close, we came down to the 20 period moving average of the highs and could be bouncing up off of that. Our different charts, the Heikin Ashi has more of a hammer or a doji sign in here, so that's turning a little bit more positive after it had been negative. The Keigi chart is still positive and is now pointing up. The Renko chart still continues to be positive. The 3-line break, though, is still looking more negative. Looking at the different indexes, we did see the equal weight do quite well, but it's still underperforming the S&P 500. When we do a ratio between the two, we actually saw this decline a little bit, which could be positive, which means there's more stocks participating in the upward move instead of just the mega cap companies. We're seeing some improvement with Dow theory here, where the transports are showing some improvement, and we're seeing some internal strength there, so that could be positive. We saw a little bit of a tick up with the utilities. That could be more short-term positive. However, the transports, even though they're showing a lot of improvement, continue to underperform the Dow. That could be longer-term negative. Looking at our discretionary and staples equal weight study, where we really went up with discretionary, we were up slightly with staples, but the ratio just shows that discretionary is outperforming staples, so that means growth is outperforming value. The Dow, this is encouraging too. We came down to this 50-period moving average, stayed there for 2 days, and now we're bouncing up off of that. We're right back up to this pivot level. With the Elders Impulse system, the Dow is now switched back to neutral. With the NASDAQ, we are still above this pivot level and showing some improvement, being up 1.65%. We're also potentially coming back up to resistance at the 61.8% retracement level. If we start to fall, we'll be watching the 50% retracement level. But when you look internally, we're still seeing the cumulative new highs minus the new lows decline. And our raw score at the bottom, when you subtract the new highs minus the new lows, continues to be negative. This is another area to keep an eye on. If we start to go back up with the NASDAQ 100, are we going to get back up to the previous high here? Or is that going to produce some more overhead resistance? The Qs have gone from being negative to switching back to neutral. The NASDAQ bullish percent index, again, this is what David Keller from stockcharts.com has pointed out. We're still seeing a decline here. He sees this as a major signal. I just see it as part of the overall evaluation process. Then looking at the NASDAQ 100, we're still a ways away from the 61.8% retracement level. And we saw just a little bit of an uptick with the Qs outperforming the Dow, but longer term, the Qs are really outperforming. The small cap index had a good day. It was up 1.75%. We're able to get back above the 200-day moving average, but we still have overhead resistance. This area right in here had been providing some good support. Now that we potentially are coming back up to that area, will that act as resistance? Then the small cap index has switched to positive after being negative. Here's the Russell 2000, where we crossed above 50 with the RSI. We're still negative with the MACD. And we saw a little bit of a tick up with the small caps to S&P 500 ratio, but the small caps continue to underperform. When we look at growth versus value, we actually saw a decline in the overall ratio, but it continues to be in an uptrend. The mid caps also were able to break above this pivot level and were up 1.61%. They have also switched back to positive after being negative with the Elder's Impulse system. And the mid-cap growth to value ratio did tick up slightly, and this is actually where we're seeing more strength right now. The home builders just continue to shoot to the moon overall. We're seeing the ETF really going up. We're seeing the ratio really going up, and the relationship between the two is getting back to being very strong. Looking at the broad range of the S&P 1500 to Treasury bond ETFs, we did tick back up slightly, and we're still outperforming. Looking at the tech sector to the 3 to 7 year bond ETF, we did tick back up after coming back down to this blue line. And another broad market look, comparing it to bonds, also saw some improvement. Home construction, compared to bonds, just continued to shoot higher. Keeping an eye on the financial sector, it did see a bit of a recovery off of the 50-period moving average, but we're still in an overall downtrend. And the financials, even though they were up, still continue to underperform the S&P 500. But keep in mind, there is some evidence to suggest that there's a lot of insider buying in the financial sector. We're also keeping an eye on this. We're far away from this red line, but if we really start to drop, we will be keeping an eye on this as a potential support level. And the regional banking ETF ticked up just slightly compared to the financial sector, but continues to be in a downtrend. Keeping an eye on bonds, we were up based on yield and down based on price. When we look at the value to growth ratio, they're seeming to get more lockstep with each other now, which would help this overall correlation start to improve. Then looking at the study between the S&P 500 and the long-term bond ETF, we're seeing a little bit of improvement with the longer-term relationship, but now we're seeing some more weakness with the shorter-term relationship. This is also another area of concern where this ratio is now starting to go back up. If the market felt more confident about interest rates, this ratio would be going down, and we're also still above the 3-month yield going back to 2007. Is that giving us a warning sign? Long term, we're still looking better with the special K. We're above the red line, but when we look at the weekly chart, we're still below the red line. And then we're seeing some improvement with our 150 and 200 period simple moving average studies. An update of our possible positive scenarios. We were able to get back above zero based on price and volume when we look at the 19-day exponential moving average of the advanced decline ratio. Also, we ticked up just slightly with the Qs to S&P, but we should have seen more strength than that. We ticked up a little bit with discretionary and a little bit with large cap growth versus large cap value. The growth to value ratios improving slightly with the large caps, really not showing improvement with the mid caps and actually showing a decline with the small caps. Then looking at the S&P 500 stocks above their 50-period moving average, where we were happy the other day because we were above 50, now we're up almost to 70. With the mid caps, we're also showing some improvement. We're up at 62. Then the small caps also showing some improvement. We are now up at 56. The percent of stocks in the S&P that are above their 200-day moving average is seeing a little bit of an improvement. We're currently at 59.8, almost 60. The S&P to utilities ratio also continues to go up. This often gives good support to the S&P. When we look at the broad range of the 5-period moving average of the highs minus the lows, we're dropping below zero, where we had been hanging in there more positive. But this is positive. We're still up in the upper range of the 10-day average of the S&P 500 highs minus the lows. If we can camp up here for a while and see some follow-through based on price, this would suggest good momentum in the S&P. On the other hand, if we start to really fall from this level, it might mean that we're extreme positive and the S&P could see some weakness. When we look at the 50-period exponential moving average of the new highs minus the new lows, we are really showing some improvement here, and our indicator is now bouncing back up and is above zero. But this is another area of concern. We had a good solid update with the S&P, but when we look at the S&P growth to value, it actually declined, even though it's still in an uptrend, but it's been more or less chopping sideways with more of a downward slope. We did decline a little bit with the staples to S&P 500 ratio, and we are declining overall. A lot of times this also gives good support to the S&P. So what's our outlook for Wednesday? The technicals, they're still positive overall, and they might be improving. We need to see more follow-through, yet we're still seeing some negative things that continue to be in the background. We have the weekly MBA Mortgage Applications Index coming out, the Advanced International Trading Goods, Advanced Retail Inventories, as well as Wholesale Inventories. And then the geopolitical events, Russia, and yes, I have to even include Belarus on the list now. We don't know if it's going to turn into something more or if it's pretty much finished by the time we hear about it, but that's just something to keep in the back of your mind. Belarus is right in between Russia and Poland. You have Russia on one side and NATO on the other side, with Belarus stuck right in the middle and Ukraine to the south. So that's why it's kind of pivotal to keep an eye on what's happening in this area. But the market is still more fixated on inflation and interest rates. We will get a little bit of Fed speak on Wednesday with Chair Powell speaking in Portugal as well as in Spain. Here is the economic calendar so far for the week. The Stock Traders Almanac statistics. We're neutral to negative with the Dow and S&P, where we look more positive now with the NASDAQ. And then we're on the 19th trading day of the month, where we're hopefully getting beyond this weaker period of June and potentially seeing some kind of a rebound as we go into the latter part of the month. Then looking at the NASDAQ, it also still tends to perform better going into the middle part of July. So our scenarios, can't really go with the down one right now because our technicals are still positive overall and they could be improving, yet we're still seeing some things turning more negative. So we're kind of in that limbo area again. It's hard to go with the up one because our ADX now is starting to show some weakness, but we would default to the positive side, and we're not really going with the sideways trend right now because the ADX, even though it's weakening, both the ADX and the moving average are still above 20, and the green line is advancing. The short-term ADX is positive, yet starting to show weakness after being extreme positive. So our warning signs, the parabolic SAR continues to be negative. The BPIs are diverging, but the S&P BPI is still holding up, even though it did not advance in Tuesday's session. The VIX is still showing that there's not a lot of fear. The Coppet curve buy signal is gone now. That's why I haven't shown the chart. The cumulative new highs, new lows for the NASDAQ continue to show weakness. The 3-month yield is above where it was back in 2007. Earnings season, it's still kind of going on, could be positive or negative. On the positive side, we have these positive seasonality and setups that are in the background that last pretty much for the whole year or indefinitely, and those still remain. The long-term special K on the daily chart is now going positive, but on the weekly chart, we are turning negative. The long-term equity put-call ratio chart that we follow is still declining, which means it's turning more positive. The Pring bottom fisher continues to generate a buy signal. The S&P is still above that downtrend channel upper line, which I haven't been showing because we're still far away from that. We're still in more of a risk-on posture. Lower price levels may provide support. We might go back and test the August 2022 high to see if that offers support. If we continue to go up, we do have some overhead resistance, especially in the NASDAQ 100. If we start to fall, we'll be watching those levels that I've tried to point out. But so far, these support levels have held. The S&P continues to outperform utilities. The NASDAQ and NASDAQ 100 had a good day. They're breaking out, but they do have overhead resistance. The Staples to S&P 500 ratio continues to decline, which is often positive for the S&P. The mid-caps generated a recent golden cross, and small and mid-cap growth is positive, especially with the mid-caps. So our conclusion. The S&P, it's still positive. It's showing some improvement, but there are still areas that are turning negative. We need to see follow-through. Short term, we're showing some improvement. Intermediate term, we're positive, yet still turning negative, but at the same time showing some improvement. Long term, we continue to be positive. Thank you. I hope you found this helpful. Again, I want to say a real warm welcome to all new subscribers. I'm so glad that you find these videos useful. I hope you have a really good day, and I will talk to you in the next video.